Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, global markets have had quite a ride this year. After the tariff-triggered sell-off back in April, we're seeing equities staging a recovery through the third quarter, helped by expectations of Fed rate cuts and a rebound in Asia, even as Europe lagged behind. But the picture is far from smooth. It seems like investors now face fresh uncertainties from President Trump's policies, lingering inflation risks, as well as a U.S. government shutdown that's already costing the economy billions of dollars a week. So how should investors be positioning themselves as we head into the final quarter of this year? Well, to help us make sense of it all, I'm joined by Sean Quek, the Managing Director and Senior Portfolio Manager of Paragon Sage Fund at Paragon Capital Management Singapore. Good morning, Sean. How are you doing today?
Good morning, Dan. I'm good, very good. Thanks for having me again.
No, it's a pleasure to have you on with us. Now, let's start with the big picture, the third quarter which just ended. So, global equity markets, it seems like they've managed to recover after that tariff-triggered sell-off earlier this year. And we're seeing much of a positive return across most major asset classes. So, walk us through the highlights, Sean. Who were the winners and losers in the third quarter? And what do you think really drove sentiment during this recovery?
To me, I think looking back at the third quarter, I would put the three winners into three segments. Basically, I'll categorize them into three segments. Firstly, those that benefited from the AI growth story, obviously. I think this is pretty obvious. So those would include mostly what I would term as the facilitators of AI infrastructure. In particular, in the quarter, we saw semiconductors or chip stocks benefiting significantly during the period. Secondly, those that benefited from President Trump's trade tariff negotiations. These stocks were sold off earlier due to the tariff uncertainty, as investors don't like uncertainty, but rebounded as Trump struck deals in the following months. So earlier in the quarter, we saw consumer product names such as Nike benefiting, and more recently is healthcare stocks that rebounded over the last few trading sessions. Finally, I would say those that have benefited from a more dovish Fed. Obviously, we saw the pivot in the Fed from a more inflation focus to a more demand side focus. So names that benefited are basically your interest rate sensitive stocks like real estate.
Interesting. Those are some good points that you raised there. And I'd like to stick to the Fed rate cut and the dovish tone that you highlighted in your last point. Now, over the next 6 months or next couple of months, it seems like sentiment is growing towards a slightly more dovish tone. And at the same time, valuations are looking sky high. We've got the S&P 500, for example, trading at forward multiples that is only seen during bubble periods. So how credible do you believe those expectations are? And how much of the rally do you think was positioning versus fundamentals catching up?
Sure. I think clearly we are in a bull market and valuations are no longer cheap. But on a bottom-up basis, we do see some gaps. So really depends on investors' investment horizon and risk appetite. Momentum clearly remains positive, although it's not easy to time the market in the short term. So for us, it's really about striking a balance between staying invested, because it is hard to time the market, but at the same time being mindful of more demanding valuations in some areas. So in terms of the Fed impact, I think the key there really is, again, demand in terms of the economy on the demand side versus prices, right, which is on the inflation side. I think as long as the inflation picture does not get out of hand from the Fed's point of view, I think they will continue to focus on the demand side, which more recently we have started to see weaker numbers. So I would say, at least in the short term, it probably, like the saying goes, right, it probably doesn't make sense to fight the Fed.
Yeah, that's a fair point that you raised right there. So with that as a backdrop, let's turn to what lies ahead in the fourth quarter. Now today, President Trump's domestic and foreign policies continue to inject uncertainty into both growth and inflation outlooks. And while the Fed has turned relatively dovish, shifting its focus from inflation to employment, inflation risks haven't disappeared. So what factors do you see driving market movements in the final quarter of this year?
So to us, since late last year, we have stressed that a broadening market performance beyond the mega cap names, well known as the Magnificent Seven, is conducive for the market rally to continue. And this has been the case. So what we saw is that in the earlier part of the year, we saw Europe outperforming global equities and China as well, Asia as well. And more recently, in the third quarter, we saw Asian markets doing well. So what we are seeing is actually despite the uncertainty in the US, the rest of the world is actually carrying on the rally that we have seen. So we continue to see this trend playing out for now. In particular, as I mentioned, momentum in the three areas that we discussed remains strong. So I think in the short term, that's going to, in the fourth quarter, that's going to help drive the market. But again, we need to be, mindful that valuations are not cheap. There are areas that valuations are more demanding than others. So we need to stay cautious on that front.
Yeah, vigilance is key. After all, valuations are at sky-high levels as of now. So we've seen how tech and chip names have done much of the heavy lifting for this year, especially with the AI boom and data center investments. I mean, if we look at the latest news building around it, we've got ChatGPT owner OpenAI's record $500 billion valuation on an employee share sale, and some of its newest packs with a group of South Korean chip makers from the likes of Samsung. So couple that up with many other AI news that's been making headlines, and we're seeing how Asia chip stocks rising up by just over $200 billion in the recent session. So do you expect that momentum to carry into the fourth quarter, or is it an already crowded AI trade with increasing fragility?
I think, again, what we have seen is that the effect of this AI growth story broadening beyond the US leaders. So, for example, earlier on, let's say most of last year and some part of this year, what we saw is that some of the leaders were the ones that were doing well. So you see a lot of funds flowing into, again, the mega tech names in the US. But more recently, especially given that, some of these contracts are actually dished out to other parts of the world, especially in Korea, as you mentioned, for example, right? So what we are also seeing is that the investor interest has actually also broadened out to this part of the world, especially. So I think that, again, is a healthy sign because, obviously what we don't want to see is very much concentration in a few names. So because of that, I think at least, for the fourth quarter, this trend is likely to continue.
Yeah, and it gives us, I guess, a chance for investors to start to broaden out their, AI plays, perhaps, to just your usual culprits. We've got NVIDIA, AMD, and perhaps, look for opportunities elsewhere. Well, let's not ignore what's happening in Washington as well. I mean, we're seeing the U.S. government entering a shutdown on October the 1st. An estimated 750,000 federal workers are either furloughed or working unpaid. Key data releases like jobs and inflation numbers are being delayed. White House itself estimates that the shutdown is shaving off about $15 billion off GDP each week as it continues to drag on. So what are the repercussions of this shutdown, and could it likely derail the Fed's easing cycle?
I think in the short term, the impact is probably limited, but it is obviously adding to the uncertainty for the economy that we're already seeing, with tariffs and so on, right? And of course, right now, in terms of data, the data flow from the public agencies, that's not forthcoming as well. So it is adding to the uncertainty. I think the key for the Fed, again, we see them remaining dovish unless inflation picture changes. And in terms of markets, it seems that market is still pretty sanguine so far.
That's fair. It does seem like it's fairly muted. I mean, we've witnessed this scene before in the past. So I guess market is sort of already priced in what's to be expected. Now let's bring it back to the portfolio level, Sean. Now, Sage has benefited this year from being overweight in Asia, and I understand that names like TSMC and Alphabet contributed positively in the third quarter. So final question for you against today's volatile backdrop. Where are you seeing opportunities for investors heading into the fourth quarter? And are you still leaning toward more Asia, or do you see value emerging from Europe and elsewhere?
I think, as alluded earlier, we continue to see a broadening of the rally over the next few months. So clearly, we are more positive in the short term on the non-US markets, including Asia and Europe. I mean, again, top-down is harder because if you look at the average for the market, valuations look demanding. But we do see pocket of opportunity in terms of from a bottom-up perspective. So our focus is still, investing in above-average companies at below-average valuation. and this process will continue for us.
Fantastic. All right. Thank you so much once again for joining us as always, Sean, and to give us your insights and take on what's happening in the latest of the markets.
Thanks, Dan. Thanks for having me again.
It's a pleasure to have you on, Sean. We've been speaking to Sean Quek, the Managing Director and Senior Portfolio Manager of Paragon Sage Fund at Paragon Capital Management Singapore. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.